Well, the Nasdaq, despite today's performance, looking to close out its eighth positive week in a row, the longest winning streak for the tech-heavy index since 2019. For more on these market moves, we're joined by Ahmed Riesgo, Insigneo Chief Investment Officer. So, Ahmed, let's get into this market action that we're seeing today. I mean, we've been seeing this tech-fueled rally. We're seeing it extend out a little bit more, more than a little bit more. Right now, what's happening? Is this really a game of catch-up? Is this kind of a FOMO play that we've been seeing?
Yeah, if I had to say, or I've had to guess between those two, I would say it's a bit more FOMO catch-up because what you're seeing is that concentration really hasn't spread or market breadth hasn't increased. This continues to be a story of the leaders leading. And if you look actually at the NASDAQ specifically, the spread between the NASDAQ and the equal-weighted NASDAQ, it's a pretty stretch. In fact, the last time we saw it this stretched was way back in late 2021. And what we noticed that happened afterwards, which is that spread tended to narrow, which means that the other components of the NASDAQ started to gain and the leaders started to lose a little bit of momentum.
Ahmed, we just heard from Jared there, kind of putting the tech rally in historical context. The NASDAQ up 8 weeks in a row. It's not something that happens often. So much of this has been driven by the enthusiasm around AI. Are you a little concerned about how quickly things have run up and to the extent that they have based on a technology or really a single play?
Right, and certainly we have. And I want to sort of preface my statements with saying that we're generally long-term very bullish on this theme of AI. We think it's going to be very productivity and profit enhancing for companies across the board, not just for the leaders over the past couple of weeks. However, if you look back at the dot-com bubble, which is the last time we think we've seen a comparable new technology kind of hit the market, so to speak, you see that there was a lot of froth built into that market, even though the technology, which in that case was the internet, ended up being revolutionary for not just those companies that were directly involved with the internet, but really for companies across the board. So we think this is going to be a very similar setup to that scenario back in the early 2000s.
So you see this as an AI bubble to you, Ahmed?
I don't think we're quite there yet. We tend to have pretty strict parameters mathematically as to what we define a bubble as, and we're not there quite yet. It's funny because you look historically, whether you're talking about the dot-com stocks of the 2000s or the Dutch tulips of the 1600s, you see that mathematically they all look the same. It doesn't really matter what the underlying asset is, and we're still not there yet in the AI. So this still has further potentially to run.
Yeah, I mean, let me follow up on that. Anytime there's a comparison to what happened in the early 2000s, you know that's going to raise alarms. I mean, are you suggesting that things could end similarly to what happened then?
Well, part of and we want to make this clear, there is a completely different setup right now, right, in terms of the macro environment. In fact, the economy right now is on pretty solid footing, although we do think that down the line over a 12-month window, the probability of a mild U.S. recession is quite high. So we're not necessarily calling for similar type of market action. Remember, we also had a massive sell-off in that space just last year. So those markets or these markets aren't currently as expensive as those were back then. So unlikely to see a similar setup.
Well, we did get some more Fed speak today with Fed Governor Christopher Waller saying he doesn't support altering the stance of monetary policy over select bank fears. The commentary comes after the Fed announced they were holding rates steady on Wednesday as they leave time to, in their words, assess additional information. At the same time, Ahmed, we got this University of Michigan Consumer Sentiment Index, which really showed inflation expectations being drawn down significantly. We're now talking about 3.3%, which is a big drop from where we saw it in May. What does that leave the Fed?
Well, to be quite honest, we think the Fed has already gone a bit too far, which is why actually we think the Fed's action could potentially have increased the chance of a recession. We think that had they kind of stayed their hand a few meetings ago, I think there would be an increased chance of achieving this soft landing, of threading the needle here. But the fact that they remain insistent on increasing rates, despite the broad-based evidence right now that we're in a pretty strong disinflationary trend. True, core inflation is not back to where the Fed wants it to be. But as with always, we don't want to look at where inflation is today. We want to see to where it's headed. And most of our indicators are pointing to a pretty strong disinflationary trend.
So, Ahmed, do you think by the time the Fed meets again, that I know, again, this has been a data-dependent Fed, and the signal has been that there's the possibility of 1 to 2 more hikes this year. But do you think that if you were to give your opinion to Chairman Jerome Powell, that they should hold the line at the next meeting?
Yes, to be quite honest, like I said, I would have probably told them that at the previous meeting, but obviously the Fed is not paying me right now to give them advice. But look, the Fed makes mistakes all the time. In fact, they more often than not tend to over ease or over tighten. So this would not be something shocking to anyone who's been a watcher of the Fed or an observer of economic history. It's much more often the case that they make a monetary policy mistake. We think that they're dangerously close to that at this moment.
In many ways, I mean, could you argue that the Fed is just expanding their options here by sort of dangling the potential of those 2 additional rate hikes by the end of the year? In addition to Christopher Waller, we also heard from Richmond Fed President Tom Barkin today, who essentially said that he's not convinced that inflation has started to draw down when you look at core inflation. I mean, that seems to be a disconnect from what you're saying, that disinflation, we are starting to see the disinflationary pressures already kick in.
Yeah, because remember, these inflation numbers, especially when you're talking about PC and CPI, they're very backward looking. So they're looking at data and they're reflecting the macroeconomic environment as of a few months ago, even in some cases. So I do have some sympathy to your point in the sense that I think the Fed might be trying to verbally intervene here into markets to actually not have to raise the rate at this point. But I think by all accounts, I think by even the most aggressive estimates of where the neutral rate is, I think we can clearly say that we are in restrictive territory at this point, and we are already starting to see signs that this is filtering through into the economy. So for them to keep further pressuring ahead, especially when we haven't seen an uptick in long-term inflation expectations, remember, those remain pretty well anchored. So we really see no reason for the Fed to continue. However, given their rhetoric and given what they've been telling us, we are expecting them to.
Ahmed, I want to switch gears a little bit and take a look at the broader market again. So we have a strategist who's predicting that the current market rally may be short-lived. This is Bank of America's Michael Hartnett. Now, he's warning that the signs pointing to a big rally before a big collapse. Now, he got last year's sell-off correct. What do you think about his point that, this is kind of just a brand new, shiny bull market, but it's going to be short-lived?
Well, we also do have some sympathy to that view. A lot of that is going to really depend on what happens with the economy. It's impossible to have a sustainable bull market before a recession has even begun, right? Because the earnings pressure on companies is going to increase going forward with the subsequent uptick in unemployment. So a lot of this is going to depend on what the forward path for the economy is. If the Fed is somehow able to thread this needle and avoid a recession, avoid over-tightness into a recession, this market certainly could be the beginning of a new bull market, and it could potentially be even longer than what he suggested. However, our indicators are pointing to heightened probability of a recession over the next 12 months, which means that we remain skeptical. Now, I do want to highlight something. We do think, though, that downside risk is quite limited because the recession that we're looking for is a pretty mild one. In fact, in some sectors, in some households, in some parts of the country, it might not even feel like a recession. So we are looking for only a minimal increase in the unemployment rate.
So what does that ultimately mean from an investment standpoint? How do you get out ahead of that? Do you stay in some of those growth names we were talking about, or is it more about the value play, potentially small caps?
Yeah, so we've actually shifted our portfolios recently, given the fact that we actually anticipated this rally kind of to start the year. The S&P recently reached our target. What we've done is that we've done a quality shift into our portfolios. And what that means is that we've increased our exposure to companies that have high quality factors. And these are companies that have high profitability because they have a high return on equity. But at the same time, they have very low leverage and they have low debt to leverage ratios. And these companies tend to perform better in environments with higher rates and slowing growth, which is precisely the environment that we think we're going into. We don't think rates are going to necessarily creep higher from here, but we do think that they will stay longer than what many previously anticipated. That is a great environment for quality.
Ahmed Riesgo, Insigneo Chief Investment Officer. Appreciate you joining us on this Friday.